Hello, welcome. It's nice to have you with me today. Welcome to Chapter 8. Welcome to long-term operating assets. And welcome to this actually the last chapter that we're working on assets. And we've been working on assets since the very beginning, actually, but when we did inventory, 2 chapters of inventories in 4 and 5, and we've done cash, we've done merchandise inventory, and accounts receivable and investment securities. Those were short-term assets, and this is our one long-term asset chapter. Now, the chapter begins on page 416 and 17, and it talks to you about operating assets. Now, operating assets are the assets that you make to produce your products. So they will be the land and the buildings and the equipment and the trains and boats and planes that you use to make your goods and to distribute your goods into the market. Now, those goods will then be sold for revenue. And so these long-term operating assets are the assets that produce the goods and the services that you sell to your customer. They produce the direct operations for revenue. So these long-term operating assets are the assets that produce the goods and services for your customers. On page 418 and 419, the authors talk to you about tangible versus intangible assets. And tangible assets are physical assets that you can see and touch and feel, and you can extract them. So when we talk about tangible assets, they tell us that they are plant, property, and equipment, natural resources, and land. So when we think about plant, property, and equipment, we are thinking about manufacturing facilities, we're thinking about distribution centers, we're thinking about equipment that actually produces the bottles of ketchup. So as we talk about physical assets, they're assets that we can see and touch and feel and extract and know that they're present. Intangible assets, on the other hand, boil down to being property rights. They give you a privilege in society that no one else has. And so they could be a copyright or a franchise or a patent, something where all you have is a property right that gives you a privilege in society that no one else has, gives you a privilege in the market that no one else has. So these intangible assets, you can't really see them. You can see a piece of paper that says, here's a franchise. You can see a piece of paper that says, this is a copyright to produce Gone with the Wind for the next 14 years or whatever they happen to be. But you don't really see the production of the asset. You just see you just have the paper representing the privilege. On 419 and 420, they talk to you then about the historical cost of these assets and how we determine the historical cost of these assets. At the top of page 419, it says for buildings, it's the purchase price, the sales tax, the title search and transfer document costs that transfer the title to the new owner, the realtors and attorney fees, the remodeling costs to get the building ready for its intended use. For land, it's the purchase price, the sales tax, the title search and transfer documents, the realtor and attorney's fees, the cost to remove an old building. So if you have to raise a building, the cost to tear that down and remove it to get the land ready for its new use. The grading costs, so that can be flat grading if you're going to make a parking lot, and it could be undulated gradings if you're going to make a skateboard park. So however it takes to get that land ready for the use, that can be part of the cost of the land. For the equipment, the purchase price, less any discounts, sales discounts, purchase discounts, those sorts of things. Sales taxes, delivery costs, installation costs, cost to adapt to its intended use. So if you have to relocate some pieces of equipment to get the new equipment in there, all those relocation costs can be charged to the new equipment, because if you didn't make those relocations, you couldn't have the equipment working. So it's all the cost to get that asset ready for its intended use. Now, when you buy assets, oftentimes you buy them in a bushel basket purchase. So you buy the land, you buy the building, and you buy the equipment inside the building perhaps. So you're getting 3 sets of assets. At the top of, they begin to talk about this at the bottom of page 419, and they say that you have, you're buying building and land, you've had it appraised, and the appraisal values are $270,000 for the building, $90,000 for the land, making it a total of $36,000. So now what you need to do is you need to know the proportion that goes to the land and the proportion that goes to the building. So $2736 go to the land, go to the building, and $936 go to the land. So approximately 1/4 and 3/4, or I think dead on 1/4 and 3/4. So when we turn the page to the top of page 420 and we say, oh, well, I paid $240,000 for both of them. So then we multiply $240,000 times 75%, and we get the amount of the $240 that's going to go towards the building, and we multiply it by 25%, and we get the amount of the cost that's going to go to the land. And you can see there that it's 180 and 60, and that makes up the $240,000 that you paid for these. Now, if it appraised for $360, but you only paid $240, you can only put the $240 on the books. You can't put that extra appraised value on the books. So it's the proportion of the appraised value. And I just showed you how to do those calculate those proportions and to do the math. On page 420 to 429, now this is the major part of the chapter, nearly 10 pages here, are about the methods of recognizing depreciation. Now, you learned the journal entries for acquiring assets and for depreciating assets back in chapter 3. You learned the methods to acquire. The journal entry is shown to you on page 161, and to depreciate is shown to you on page 162. So those journal entries are the same journal entries you're going to use throughout this chapter 8. They don't show you many journal entries in chapter 8 because they're expecting you to bring those forward from chapter 3. So what is depreciation? Depreciation is merely the systematic and rational allocation of costs that you paid for an asset over the useful life of that asset. So we need to find systematic and rational methods that assign the cost of the asset periodically every year to the cost to expense, to match revenues and expenses for the revenue that you earned that year from producing those products and selling those products. So as we look at recognizing first the asset, we debit land and credit cash, or we debit building, debit land, credit cash, whatever the journal entry is to acquire that asset. And then we have to allocate that cost over the useful life of the building, and over the useful life of the land, and over the useful life of the equipment, or over the useful life of the natural resource, whatever it is. So that's the task that we're looking at on pages 420 to 429. Now, there are some elements that you use here for this systematic and rational allocation. The first one is the cost, and we've looked at the cost in the preceding 3 pages and how we would go about determining the cost of the asset. Now, the salvage value is how much I think I can get for this asset when I dispose of it at the end. Can I sell it as a used product and get a certain amount of money? Can I only have it picked up and get a scrap value for it? Is that all I can get for it? Management has to make that estimate, has to make that determination. How much will I be able to retrieve when I'm finally finished using this asset? And that will become my salvage value. I have to estimate the life. How long will this asset last? 3 years, 5 years, 10 years, 20 years. Management makes that estimate. And then how many units will this asset produce? How many miles will this truck drive? How many hours will this plane fly? How many copies will this machine produce? How many newspapers will this printer print? So you're making these estimates. Now, those are generally made by engineers who understand the assets, and those aren't just guesses that you pull out of a hat, but they are reasoned estimates made by a professional, someone qualified to do this. And there would, when you were going through the financial analysis to decide if you were going to buy this asset, which is what you'll do in your Finance 360 class, you will work with engineers, and you'll have a very good idea of how long this piece of equipment, this asset, is going to last, how long we're going to be able to use this, how many units it will produce for us. So you can just use those factors and bring them forward to the depreciation considerations. But the salvage, the life, and the units are all estimates. Now, we've made other estimates in accounting before, and there are a number of estimates that accountants require someone in the enterprise to make. And so you should not be uncomfortable with them, just maybe amazed at how many of them there are. Now, there are 4 depreciation methods shown in this chapter, and the first one is called straight line depreciation. It starts on page 421 and goes to page 424. And the formula for straight line depreciation is cost minus salvage divided by life. So this is a systematic allocation of the cost minus the salvage that you're going to get back for it later. You don't have to expense that. And then the rest of the cost is allocated systematically over the life, however many years you think this asset's going to last. And so straight line depreciation gives you a constant flat depreciation, the same amount every year. So if you were to look at it graphically and it was this much money over time, it would be a nice flat line. Strengths of straight line depreciation is easy. It gives you a smooth income line that doesn't impact net income. Once it's set, it's the same impact on net income over the entire life of the asset. So those are some of the strengths of straight line depreciation. And the way the authors present that is in life cycle 1, you go and get your money, and in life cycle 2, you spend it on buying a van, and in life cycle 3, you get some income from the van, and then in cycle 4, in cycle 3, you got to match, get the revenue, you got to match the expenses against that, so you've got the depreciation expense that you'll allocate every year. And then in phase 4, you're disposing of the asset, you're selling it, so when you dispose of it, you have to get rid of the asset, carries a debit balance, so you're going to have to credit it to get rid of it. So you're going to credit van. You've got the accumulated depreciation. It's a contra asset, carries a credit balance, and you'll have to debit it to get rid of it. Now, you might be selling this van for a little bit of money, so you'd be debiting cash for however much money you're going to get for it. And now what you've got in that journal entry is the amount of cash you're going to recover at the end and the book value. So if the selling price is higher than the book value, you're going to have a gain on the sale of the asset. And if the price is less than the book value, you're going to have a loss. And so you recognize the gain or loss at the time of the sale. And that's shown to you on page 423. So in the financial statements then, you get to see how straight line depreciation shows the expense and how it shows the accumulated depreciation. Now, you've been asking me to tell you about some depreciation financial statements. So here's an income statement, here's a balance sheet, here's a statement of cash flows. We're going to be focusing on those financial statements, so you want to mark down this page 424. You want to notice the comparisons that are made. You want to notice the accounts that are listed underneath each of these parts of the income statement, the balance sheet, and the cash flow statement. Now, these will not have an impact on the statement of change in owner's equity because they are closed into retained earnings. The depreciation expense is closed into retained earnings, but that shows up in the income statement. So we don't really show you the statement of change in stockholders' equity because contributed capital and earned capital are shown in aggregate numbers. We don't have any individual information in that particular statement about depreciations. The next method is called the declining balance method. And the declining balance method is an accelerated method of depreciation. It is allowable in generally accepted accounting principles. And this accelerated method allows you to take more depreciation in the early years of the asset and less depreciation in the later years of the asset. It's presented on pages 425 to 27. And the argument that supports this depreciation method says, as assets get older, there's higher maintenance costs. So if we can depreciate more in the early years of the life of the asset and have higher maintenance costs in the later years of the asset, we'll really have a smoother income depiction because we will have compensated for those higher maintenance expenses later by having higher depreciation early. And so that is one compelling argument. I think that's the compelling argument that won the hearts of the promulgators to get it into GAAP and to keep it in the tax code. But the other strong management argument is that higher depreciation expense means lower net income, and lower net income means less tax obligation. And so there's a real incentive due to the time value of money to depreciate something as quickly as you can, pay less tax on it, and have that less tax money that you didn't pay still in your business to use in other ways, to use in ways you want to use it as a manager. So the accelerated depreciation gives a tax advantage of not paying as much tax expense in cash early in the life of the asset. Now there are declining balances, accelerated depreciation. There are three of them, 2.0, 1.5, and 1.25. And the code is very clear about when you can use which ones. In class, we're going to teach you the double declining method, the 2.0 acceleration factor. So we're going to go twice as fast as straight line. But you want to realize that there are more than one, but there's very restricted use on the other two, and the 2.0 is more generally applicable. Now, on page 425, you'll notice that the formula that is set up there for double declining balance, well, for declining balance, is to make it a percentage of the declining book value balance. So cost minus accumulated depreciation is the book value. So we want to do a percentage of that declining balance. That balance is getting smaller. We want to do a percentage of that balance. Now, you could take a percentage of a percentage of a percentage forever. It becomes asymptotic to the timeline, so it's coming down and it's giving you a lot of depreciation early on and less depreciation later, but it will never actually touch the timeline. It'll just cruise along and catch it by that percentage of a percentage. So with this method, we do have to force this method to end at the end of the life, or when it's the salvage value, when the book value is equal to the salvage value, and we just stop depreciating it. So you want to keep that in mind, that this one is not about cost and salvage like the others. This one is a percentage of the book value. So you'll notice it's cost minus depreciation, accumulated depreciation, and then this asset had a 4-year life, and so to convert 4 into a percentage, or convert any number into a percentage, you have to divide it into 1, to 1.00. So you have 1.00, and you divide 4 into that, and you get 0.25. So it's 25% a year. 5 divided into 1.00, it's 20% a year. So you do want to remember that we get a percentage, and a percentage is always a proportion of 1.0, a proportion of 1. So in this particular case, it was a 25% straight line depreciation. So times 2, the acceleration factor, would make it a 50% acceleration factor. So it's a $24,000 asset. It has no accumulated depreciation, and twice the straight line rate is 50%. So you actually get 50% of the depreciation, half of the total depreciation in the first year, $12,000. But now what happens, remember, it's declining balance. So the 24 minus the 12,000 depreciation from last year gives me a book value of only 12,000. So I want 50% of 12,000, which is 6,000. Now my accumulated depreciation is 12,000 plus 6,000, or 18,000. So now my book value is down to 6,000. So 50% of 6,000 is $3,000. And you could depreciate that much. And you can see there in the table how much can be depreciated. But the message they're trying to give you is that the regulations in the United States allow you to convert from declining balance to straight line once in the life of the asset. And so at the point in time where the straight line is greater than the declining balance, then you would just go ahead and do the straight line method. So you can see that in this asset, the straight line method would be $2,000 in year 15, and this would be finished. So you can switch to the straight line method and once in the life of the asset. And then after that, you have to use the straight line method. Okay, the effects on the financial statement. Again, that very nice presentation. Be sure that you're watching these financial statements. You're looking at them, because we're going to be working on these now for the next few weeks. So this is where our area of focus is going to be, is on these financial statements. And then the units of production. There's a very helpful check yourself at the top of page 427 about declining balance. Then on the middle of 427, we start units of production. And units of production are cost minus salvage, divide by the total number of units you expect to get out of this asset. So whether it's miles or hours or a number of units of product or number of hours that the computer will work, or the number of CPU milliseconds, whatever it might be that you want to use. You do cost minus salvage, and then you divide by that total output to get a cost per unit of that output. And then every year, for the number of units that you used, you multiply that times the number of units times the cost per unit, and that becomes your depreciation expense. So at the bottom of page 427, it's 20 cents per mile that they're charging themselves for depreciation for this vehicle. And so it's 40,000, 20,000, 30,000, 15,000. And so then you charge yourself that many dollars of depreciation. Again, noticing at the bottom, remember the salvage value here is 2,000, so it can't go below 2,000. So I have to stop this depreciation in year 16 and make sure that I leave the correct book value in there to match the salvage value. Now, again, nice financial statements on page 428, and you can compare how financial statements look when you're using this kind of method where you see this oscillation, this change. One year we drive the car 20,000, then we do 30, then we go down to 15. So it's not a nice smooth line of depreciation. So in fact, on the top of page 429, they have an excellent graphic to show you. You've been watching me talk with my hands, so you see a brown golden line, and it's a really flat, straight line depreciation. You see the blue line, that's the declining value that's coming down and almost touching the timeline. In fact, it has to be stopped at some point so that you don't depreciate more than the salvage value. But you can see how quickly you decline those values. Then you can see the red line that's changing, that's going up and down, that has oscillations in it because it's based on units. And when you think about the impact of that oscillation, you think, how am I going to explain the difference in net income between year 2 and year 3? When in year 2 I didn't have this very much expense, but in year 3 I had a lot of expense. So those are the kinds of conditions management would consider in making an estimate. So the fourth method then is called Marks, and it is the Modified Accelerated Cost Recovery System. Now, the accelerated depreciation, the IRS knows that people want to use the accelerated method. You want to get the benefits of that blue line you see at the top of page 429. You want to get all that expense early, low net income, save money in taxes, have lower depreciation expenses when you have to take on the maintenance cost. You want all those benefits. So the IRS has come up with this Modified Accelerated Cost Recovery System, and it is actually a set of tables in the IRS code, and therefore percentages of years, so 5-year property, 7-year property, 10-year property, whatever your life is going to be, and then each year that you own it, you use this proportion from the you weight it by this proportion from the tax code. So you would take the cost of the asset times the fraction that's given there, so 20.00, 32.00, 19.2. Now those are actual percentages, so you have to move the decimal point out to the front. So it would be 20%, 32%, 19.2%. That should be multiplying the historic cost by those amounts. And then that's your depreciation expense over the life of the asset until it's fully depreciated. Marks has a convention in it that you take half of the depreciation in the year of acquisition. So whatever the first year is, you take half that depreciation in the year of acquisition. And you take half in the year of disposal. So when you're ready to dispose of this asset, you take that other half of that depreciation. Now, management, it's not an election for management if you're going to do marks. Marks has it set up that way, and the law has it formulated so that you have to do that. But in the other depreciation methods, management can decide to take a full year in the year of acquisition. They can decide to take a half in the year of acquisition. They can decide to do it a proportion. I own this for 9/12 of the year, so I'll take 9/12 in the first year, 3/12 in the later year. So management can make a determination on how they want to handle the year of acquisition and the year of disposal. But under marks, it's specified by the tax code. So that's the fourth method that's given to you. And you'll find that your Excel lesson is a major table asking you to calculate and compare all of these various tax code methods for 5 years, and with an asset. And those are it's a classic give me a comparison schedule. And management will say to an accountant, you managers will say to us accountants, give me a comparison table, give me a comparison schedule, and we'll go make up a schedule just like you're going to prepare very real life. And part of the reason that we set it up nowadays on the computer and with Excel or some other software is the next part of the chapter, and that's about revisions of estimates. And that's on page 431. And revisions go on page 431 and 32. And there are 2 revisions that are prominent here. And one is the revision of life. So you might have an asset, and partway through the asset you begin to realize that it's going to last longer or it's going to last shorter. And you don't know, you didn't know that when you set it up. So once you realize that this asset is going to last longer or shorter, you have to revise it at that time, and you have to recognize it in the books. And the way we recognize it in the books is to take the book value at the time of recognition minus the cost and divide that by the new life. So if the new life is shorter, the depreciation gets bigger. If the new life is longer, the depreciation gets smaller, because you're either amortizing it over more years or you're amortizing it over less years. And what you're trying to be is forthright with the readers of financial statement, disclosing how long this asset's going to really last. It's not how much the depreciation expense is that's critical. It's the life of the asset and its productive, useful life. The second estimate that can need to be changed is salvage value. And salvage value is the amount you expect to recover at the end. And salvage value can be 0. And sometimes salvage value can be a negative number if you're going to have to spend a lot of money to get rid of that asset. And that might happen with natural resource considerations. I mean, not just restoration of a natural resource you might have, but you might have equipment that you can't just dump in the ocean or put in the landfill. So you're going to have to find ways to dispose of it, and it's going to cost you money once you're not using it any longer. So we realize that the salvage value, we say less the salvage value, but in your careers you might encounter some that have plus the salvage value. So now what you're going to do is book value at the time that you realize the salvage value has to change, minus the new salvage value to get the cost of the asset. And you divide it by the remaining life, or the number of units. You get a new cost per unit, or over the remaining life, and then that becomes the depreciation in the future. So when you look at these revisions of life and salvage, you begin to realize that estimates can be proven to be faulty, and we may have to change them. And so when we have to change them, accountants are going to say, as soon as you realize it's going to happen, tell us and we want to recognize it in the books, and we want to change the estimate. And when we have to change those estimates, you'll be glad you have that. You took the time to build that Excel spreadsheet that you have to build this week, so you can go through and make one change in that data table, and it'll change everything for you. That's another reason for using the data table and creating those Excel spreadsheets. The next section of the chapter is continuing expenditures for plant operations. And remember, this was one of the arguments about the accelerated depreciation, is that there's increased maintenance as the assets get older. This is discussed on pages 432 and 430 to 434. And when you see that you have to make an expenditure, you have to make a determination. And so the accountant will probably lead this discussion, but management should be informed about it, and so you should be informed about it. There are routine expenses. The oil needs to be changed, the tires need to be replaced, the property needs to be painted, the broken window needs to be repaired. So you have repairs and maintenance, and you just have to do those in order to protect your fixed assets. So those are operating expenses. Those are charged to expenses. Now, I once had a client who was a contractor and built major interstate highways and had a fleet of those earth movers that you see. And we got into a major discussion over whether changing the tires, replacing the tires on that, was a capital cost or it was an operating expense. And unfortunately, they're just like any other tires. Tires on airplanes are very expensive, but they're just a routine changing the tires. Now, if there are some conditions when you could consider it something else, but we're not talking about how much does this expense cost. We're talking about, is it routine? Is it something that has to be done to maintain the capacity of the asset the way we have it? Conversely to that are capitalized expenses. And there are two conditions where you can capitalize expenses. The first one is to improve the quality of the products. So if you're making an improvement in the quality of the products, the quality of the outcome, it can make more units per hour because you changed a part, or you upgraded something. We're primarily not looking for replacements, but for upgrades, for improvements. So there's a quality or a quantity improvement. Then you can capitalize the cost. In that case, you debit the asset for those improvements. You don't have to debit the expense. Now, your amortization expense will go up, but not all at one time, and just systematically over the remaining life of the asset. Secondly is if the life is going to be extended, so you can capitalize the cost if suddenly this thing is going to last us longer. So we can make this improvement, we can put in this new this extra RAM, or we can put in this higher compressor, and it will last us, it will cause the asset to last longer. If it's going to last longer, then you debit accumulated depreciation and adjust the depreciation expense, the new book value, and adjust the depreciation expense, but you can capitalize it and you don't have to absorb the cost of those improvements all in the year of acquisition and the year that you discover you're going to make that improvement. You can make the improvement, put it to the, capitalize the cost either to the asset or to the accumulated depreciation, and then you can continue to depreciate, and you don't have as much expense as you would have in the 1 year you made those improvements. So this is discussed starting on page 432. Here they do show you journal entries. They talk about improving quality and extending life, and they show you that if you're improving quality, you debit the machine, and if you're extending life, you debit accumulated depreciation. And they have, again, a nice check yourself, compare, get an understanding of the alternatives and why you might want to go one way or another. You can generally, management is interested in calling it a capitalized cost if it's expensive. So we accountants have to take a very prudent and sagely approach and say, now, was this really a quality improvement or a life improvement? And show me the numbers for that. I guess we accountants probably say, show me the numbers quite often. The next topic is natural resources. It's page 434 to 435. And when you're thinking about natural resources, you're thinking about assets like oil or gas or coal or silver or copper or gold or trees, something that nature presents to us. And so it's a resource that you can use, but it's a resource that's native to a particular part of the world or to a particular condition. Now, for natural resources, we deplete natural resources. So it's depletion expense because the amount of that natural resource is going down. Depletion, you debit depletion expense and credit the asset and make the asset's value go down as you deplete out the cost of the original acquisition of the natural resource. Now, it's cost of the asset by the total unit production. So here's one where you have cost of the asset and you might have to estimate how much it's going to cost you to return that asset to its original state and make a decision on, are we going to absorb that cost now or that cost later. So cost divided by total production and then times the production for that year. And I was thinking that I had a table here, but I don't. So on page 435, you'll see that they get a cost per ton of coal what it cost them to buy that coal mine. And so they get 25 cents per ton. And so they did 360,000 tons that year times 25 cents per ton, and $90,000 is depleted out of the cost of that original asset. And of course you could estimate how much you think would be coming out depleted, but you couldn't actually know it. So you get the cost per unit, cost per ton, cost per barrel of oil, whatever it might be. And then you have to wait until you know how many are extracted that particular year or how many board feet of timber are actually cut that year and pulled off the land. So you can't know that one ahead of time. You can estimate it, but you have to wait until it actually happens. The next subject is intangible assets, and intangible assets are they start on page 435 here and go to 439. So you'll see that they come all the way over there. It's a nice presentation. Now, intangible assets are assets, remember, you can't see or touch or feel, but you have some sort of property right that you can exercise. So they give a nice presentation of these. They talk about trademarks, they talk about patents, they talk about copyrights, they talk about franchises, they talk about goodwill. And so I think this is a section of the chapter you should really consider reading, because while you might know something about those, you probably don't have a keen understanding of them because they're a condition of our society, a legal privilege that's given to someone, but we don't talk about them a lot. And so it might help you to read about them here to have an understanding of how they work. Now, there are two categories of intangible assets. One category of intangible assets are assets that have a definite life. They have an identifiable, definitive length for which they are good. So you might get a copyright for a book for 17 years and you'll be the only person who can print Gone with the Wind for the next 17 years. You might get it with one right of renewal, and so you would be going 17 years and one right of renewal, 34 years. Nobody else can print Gone with the Wind but me for that period of time. You might have a franchise, and McDonald's has given you a franchise for a particular location, and they told you you'll have that franchise for 20 years. And then you'll have the first right of refusal to renew that franchise after the 20 years. Well, you've got a definite period of time. You've got 20 years for sure, and you've got first right of refusal for the next 20 years. So those identifiable useful life of these intangible assets, those assets can be amortized, those intangible assets can be amortized over that definite life. So you can amortize that copyright for 17 years. So whatever it cost you to get the copyright, you would just do cost, divide by 17, and you charge yourself that much amortization expense every year. The other group of assets have an indefinite life. They're going to last for an undisclosed period of time, an unidentified period of time. So goodwill is that way. Goodwill is an asset that's created when you pay more for a business than the physical assets add up to. And so you have this goodwill, and it's going to last for a period of time, but you don't know how long. So what you do on goodwill is you recognize goodwill. You don't amortize it every year, but every year you test its impairment. Every year you test to see if it still has value. And if it still has value, you don't have to write it down. But if its value has been impaired in some way, then you have to write it down to its new value. So any year that you find impairment, something has diminished the value of that intangible asset, that goodwill, then you have to write it down by the amount of the reduction in value for that goodwill. You can you can have goodwill and not have to do anything to it for a few years, and then maybe 1 year have to absorb a write-off for impairment. Now, the balance sheet presentation on page 439 is, and it's Exhibit 8.7. So here you have it, Exhibit 8.7, and here you have the list of accounts, and you have how they're presented over here, and where math is initiated with an underline so that the reader can tell math is starting there. So that is an excellent presentation, page 439, and it covers this entire chapter. So it's called a partial balance sheet, Exhibit 8.7, and it has a bold heading for long-term assets. It has the first category of long-term assets are plant and equipment, so there's a heading plant and equipment, and then there's buildings less accumulated depreciation. There's equipment less accumulated depreciation, then total plant and equipment. And then there's land, doesn't depreciate, so its historical cost remains constant. Then there's a heading for natural resources, and we have mineral deposits, less depletion, oil reserves, less depletion, to get total natural resources. There are intangible, a heading for intangibles, and we've got patent net of amortization, meaning there's an identifiable life for that patent, and then we've got goodwill with no disclosure. So we don't know how long that, and it's not being amortized, and it will be checked for impairment every year. Then you get total intangibles, and then you get total long-term assets. Now remember that you take subtotals coming in from the right and towards the left. So you start out to the right, come in to take a subtotal, and come in to take a subtotal. So when you actually look at this page, you'll notice that the buildings less the accumulated depreciation give you the book value, and the subtotal is in the second column, whereas the determination is in the first column to the left. And then you get cost minus accumulated depreciation for a subtotal in the middle column. You add those two together and the total column goes all the way over to the right. So every time we're taking a subtotal, we're coming in a column to the left. And then the final totals are in the right. And so you've got, every time you start a new column, you have to put in a dollar sign. You have to put in underlines whenever you're doing mathematics so the reader can tell that some mathematics is starting there. We know we might have to go over and look at the designation less to know that they're being subtracted, but that's all right. And then we do these same presentations, and the very last grand total has a double underline. So I would encourage you to mark this page, follow this page, see exactly, watch the details, and see exactly what they're doing. We've been talking about the financial analyst, and every chapter has had this introduction about the financial analyst and then something about ratios. Now, ratios are a very elementary beginning analysis. You'll use them in management accounting 252. You'll use them in finance in 360. Now in finance, they'll be your very elementary beginning analysis, and then you'll get much more sophisticated building on the information that you find about the company, but you'll still do these ratios. Now I wanted to remind you that the ratios for the entire book are in Appendix C, and that's on page 754 to 756. They're identified by chapter. Now the ratios for this chapter are the debt to asset ratio, the return on asset ratio, the return on equity ratio, and the return on sales ratios. Those were all given to you in the first early part of the book. I think those are from chapter 3 and 4, but you can find those under the earlier chapters. They're just applied here again. And you'll look under chapter 8 and there aren't any ratios disclosed because there's no new ratios that come on with chapter 8. But Appendix C has all those ratios set out and explained for you and shows you where they're presented. Now, in talking about the effects of judgment and estimates, on page 440, they give us two companies, Alpha and Zeta, and they have identical economic events, the same revenue, the same cost of goods sold. They have the same price of an asset, same useful life, same salvage value. And so how will the companies differ when Alpha uses straight line and Zeta uses double declining balance? So they show you the straight line depreciation calculation. They show you the double declining balance calculation. And since it's double declining balance, once you know that it's $4,000 a year, you know in the first year they're going to get $8,000 at Zeta the first time through. So then they give you an income statement of comparison and a plant, property, and equipment comparison. And Alpha has $16,000 of income, but Zeta has $12,000 of net income. Now some people would say, oh, we always want more net income. And this is one of those cases where management really will have to make a decision about what they want. And there will be a couple of compelling arguments that they will consider in using these accelerated depreciation. The first one is at $12,000 net income, and if it was 12 million or 12 billion, it would really make a significant difference. They're going to pay less tax. So there would be a lot of managers who would look at that and say, at a 35-40% tax rate, I don't want to pay that much money out in tax. I'll have lower net income and more cash held back in my business that I don't have to send to the IRS. Now, We talk in here about disclosures and how management conveys that information to readers of the financial statements. In Appendix B, which I'm going to hold up and show you here, kill myself with this book. Here's Appendix B, and here's Target's financial statements, and this is the cover page, and this is some explanation. This is an index, so you can see what's happening. And the first note that's always given in financial statement discloses the significant accounting practices and procedures. So all these estimates are disclosed to readers. You'll find that they have general information, financial information, seasonality, merchandise, distribution, employee hiring, working capital, competition, intellectual property, geographical information, available information on risk factors, and the rest of this about the business. Now, when we get over here to the end of this, where they're actually talking about valuation techniques and fair market values, and they disclose in here the estimates that management has to make, and how management made those derivatives and leases, so inventories and other current assets. So they tell us what management was thinking. So once we know that management is taking this double declining balance, this accelerated depreciation method, we know that they're trying to get as much depreciation early in the life of the asset as possible. They're going to pay less tax because they do that in the early years. That just means eventually they'll have to pay the rest of the tax, but at the early years, that'll be cash due to the time value of money. They want that as early as possible so they can reinvest it in the business. And then when they get those higher operating expenses later, they'll have less depreciation. So be sure that you look at the financial analyst. Be sure that you look at the effects of judgment and estimates on some of these issues about fixed assets. And remember that cost is a historical reality. That was the amount of cash that went out. But salvage life and total units of production are all estimates that management makes. And so there could be some effects on the financial statements as they show with alpha and zeta. Finally, they talk about industry characteristics. And there are industry peculiarities with respect to assets. So the comparison that they give is manpower versus Verizon versus Southwest Airlines. Well, Verizon, we buy our own phones. They lease satellite time to be able to serve us, and they have some cell towers places, but basically their fixed assets are a few stores across the country and satellite towers. Whereas Southwest Airlines has a very complex and diverse asset base. And there's a picture here of a great big airplane. And Southwest has a fleet of those. And so the differences in industry peculiarities about these asset bases are really important to the investor. They're important to the lender, and they're important to management in making their decisions. Well, that brings me to the end of Chapter 8 and the discussion that's here. So I welcome you again to this last chapter on assets, the fixed long-term operating assets. There are many other assets, we just don't cover them all, but I think you have a good presentation of assets between chapters 4 to 8, those 5 chapters. And I thank you for listening to this overview of the chapter. I thank you for considering these topics that the authors find important enough to present, and I'm looking forward to working with you this week on Chapter 8.